Question 1. An insured purchased a life insurance policy and named his wife as the beneficiary. If he dies, how is the death benefit normally treated for tax purposes? A. It is taxed as ordinary income to the beneficiary. B. It is subject to federal estate tax only. C. It is received by the beneficiary income tax-free. D. It is taxed as a capital gain. Answer: C. It is received by the beneficiary income tax-free. The primary advantage of a life insurance death benefit is that it is paid to the beneficiary completely free of federal income tax. This core concept ensures that the full amount of the policy is available to the family for financial support without being reduced by taxes. For example, if a person has a $500,000 policy and passes away, the beneficiary receives the entire $500,000. Just remember this simple rule: death benefits are meant for immediate financial relief, so they are generally received income tax-free. Question 2. Under a health insurance policy, the provision that states the insured must wait a specific period of time after the policy's effective date before coverage for certain conditions begins is known as the A. Elimination period. B. Probationary period. C. Grace period. D. Incontestable period. Answer: B. Probationary period. The probationary period is a one-time waiting period at the beginning of a health insurance policy before benefits for sickness-related conditions will be paid. This provision is designed to protect the insurer from adverse selection, which is the tendency for people with a higher-than-average risk of loss to seek insurance. For example, a policy might have a 15-day probationary period for sickness, meaning any illness that manifests in the first 15 days is not covered. Think of it as a brief trial phase for sickness coverage right when the policy starts. Question 3. All of the following are considered activities of daily living, ADLs, that trigger benefits in a long-term care policy except A. Bathing. B. Dressing. C. Driving. D. Eating. Answer: C. Driving. Activities of daily living, or ADLs, are fundamental self-care tasks used to measure a person's level of impairment and determine their eligibility for long-term care benefits. The standard ADLs typically include bathing, dressing, eating, toileting, continence, and transferring, moving from a bed to a chair. While driving is an important daily function, it is not considered a basic measure of self-care for LTC qualification purposes. A simple way to remember the ADLs is to think about the essential tasks a person must do to care for themselves each day without assistance. Question 4. An applicant for life insurance makes a statement on the application that she believes to be true to the best of her knowledge. This statement is considered A. Warranty. B. Representation. C. Concealment. D. Misstatement. Answer: B. Representation. A representation is a statement made on an insurance application that the applicant believes to be true to the best of their knowledge. The key concept here is that insurance contracts are based on utmost good faith, and the insurer trusts the applicant's statements are truthful. Unlike a warranty, which must be absolutely true, a representation only needs to be substantially true. For instance, stating your weight as 180 pounds when it's actually 182 is a representation, not a material falsehood that would void the policy. Question 5. The period during which an annuitant receives income payments from their annuity is called the A. Accumulation period. B. Annuitization period. C. Deferral period. D. Vesting period. Answer: B. Annuitization period. The annuitization period, also known as the payout or liquidation period, is the phase when the annuity begins making regular income payments to the annuitant. This follows the accumulation period, where the money inside the annuity grows. Think of it like a two-stage financial journey. You spend years saving and growing money, accumulation, and then you annuitize it to turn that lump sum into a steady stream of retirement income, annuitization. Remember, annuitization is the process of converting savings into an income stream. Question 6. A life insurance policy that offers flexible premiums, a flexible death benefit, and the choice of how the cash value is invested is known as A. Whole life. B. Term life. C. Universal life. D. Endowment policy. Answer: C. Universal life. Universal life insurance is characterized by its flexibility, allowing the policy owner to adjust premium payments and the death benefit amount as their financial needs change. The policy unbundles the insurance, savings, and expense components, providing transparency and control. For example, a policy owner could pay the minimum premium to keep the policy in force or pay a larger premium to build cash value faster. The keyword to associate with universal life is flexibility in both premiums and death benefits. Question 7. The Texas Life and Health Insurance Guaranty Association is funded by A. The state's general tax revenue. B. The policyholders through a direct surcharge. C. Assessments on member insurance companies. D. The federal government. Answer: C. Assessments on member insurance companies. The Texas Life and Health Insurance Guaranty Association provides a safety net for policyholders if an insurance company becomes insolvent and cannot pay its claims. It is funded by levying assessments on all licensed insurance companies operating in the state. This means the other healthy insurers collectively cover the obligations of the failed company, ensuring that consumers' policies are protected up to certain statutory limits. Think of it as a mandatory protection fund where the insurance industry itself takes responsibility for protecting the public from a member's failure. Question 8. In a group life insurance plan, an employee who is terminating employment has the right to convert their group coverage to an individual policy. A. Only after proving insurability. B. Within 31 days without evidence of insurability. C. At any time within 1 year of termination. D. By paying a penalty to the group policyholder. Answer: B. Within 31 days without evidence of insurability. The conversion privilege is a standard provision in group life insurance that allows an employee leaving the group to convert their term coverage into an individual permanent policy. The critical part of this benefit is that the conversion must be allowed without the employee having to provide evidence of insurability, meaning they can't be denied due to health issues. This valuable right must be exercised within a 31-day window following termination of employment. Always remember this 31-day rule as a crucial protection for employees who might otherwise become uninsurable. Question 9. An individual purchased a life insurance policy and died by suicide 8 months later. What action will the insurance company most likely take? A. Pay the full death benefit to the beneficiary. B. Deny the claim but return the premiums paid to the beneficiary. C. Pay half of the death benefit and return half the premiums. D. Deny the claim and retain all premiums paid. Answer: B. Deny the claim but return the premiums paid to the beneficiary. The suicide provision in a life insurance policy states that if the insured commits suicide within a specified period, typically the first 2 years of the policy, the insurer will not pay the death benefit but will refund all premiums paid. This clause protects the insurer from adverse selection, where someone might purchase a large policy with the intent of committing suicide for the financial gain of their beneficiaries. Since the death occurred 8 months later, which is well within the 2-year exclusionary period, the company's only obligation is to return the money the policy owner paid. Remember this simple rule: within the first 2 years, suicide results in a return of premium. After 2 years, the full death benefit is generally paid. Question 10. Which of the following is the defining characteristic of a health maintenance organization, HMO? A. It allows members to see any doctor without a referral. B. It requires members to use in-network providers and designates a primary care physician. C. It pays claims on a fee-for-service basis. D. It does not cover preventive care services. Answer: B. It requires members to use in-network providers and designates a primary care physician. The core concept of an HMO is managed care through a specific network of doctors and hospitals, with an emphasis on preventive medicine. Members must choose a primary care physician, PCP, who acts as a gatekeeper, meaning the member must get a referral from the PCP before seeing a specialist. Care received outside the HMO's network is typically not covered except in emergencies. Remember that HMOs are all about managing costs and care through a structured network and a designated PCP. Question 11. Which policy provision prevents an insurer from canceling a life insurance policy after it has been in force for 2 years, even in the event of misrepresentation on the application? A. Grace period. B. Reinstatement clause. C. Incontestability clause. D. Free look provision. Answer: C. Incontestability clause. The incontestability clause is a crucial policyholder protection that prevents the insurer from voiding a life insurance policy for misstatements after a specified period, typically 2 years from the issue date. Once this period passes, the policy is considered incontestable, and the insurer cannot deny a claim based on an error, omission, or even a fraudulent statement made on the original application, except for non-payment of premiums. This provision provides assurance to the beneficiary that the claim will be paid after the policy has been in force for a reasonable time. Think of it as a statute of limitations on the insurer's right to challenge the policy's validity. Question 12. Which rider, when added to a life insurance policy, will pay the premium if the policy owner becomes totally and permanently disabled? A. Accidental death benefit rider. B. Guaranteed insurability rider. C. Cost of living rider. D. Waiver of premium rider. Answer: D. Waiver of premium rider. The waiver of premium rider is a valuable benefit that protects a policy from lapsing if the insured policy owner suffers a total disability. If the insured meets the policy's definition of disability after a waiting period, often 6 months, the insurance company will waive, or pay, the policy premiums for the duration of the disability. This ensures the life insurance coverage remains active even when the policy owner cannot afford the payments due to their disability. This rider essentially provides its own form of disability insurance for the policy premiums themselves. Question 13. In Texas, a life insurance policy must include a provision that allows the policy owner to return the policy within a specified number of days for a full refund of the premium paid. This provision is known as the A. Grace period. B. Free look provision. C. Conversion privilege. D. Reinstatement provision. Answer: B. Free look provision. The free look provision grants the policy owner a set period, mandated by state law, to review a newly issued policy and decide if they want to keep it. In Texas, this period is typically 10 days, or longer for certain policies like Medicare supplements, during which the policy can be returned for any reason for a complete refund of all premiums paid. This consumer protection rule ensures that individuals have time to read the contract carefully and make a final, informed decision without pressure. Think of it as a no questions asked return window for an insurance policy. Question 14. An individual purchases an annuity and pays a single lump sum to the insurer. Income payments to the annuitant are scheduled to begin in 2 years. This type of annuity is A. Single premium immediate annuity. B. Flexible premium immediate annuity. C. Single premium deferred annuity. D. Flexible premium deferred annuity. Answer: C. Single premium deferred annuity. This annuity is defined by 2 key factors: how it is funded and when payments begin. Single premium means it was purchased with a single lump sum payment, and deferred means the income payments will begin at a future date, in this case, more than 1 year after the purchase. An immediate annuity, by contrast, would begin making payments within 1 year of the premium payment. Simply break down the name. Single premium refers to the one-time payment, and deferred refers to the delayed start of income. Question 15. The federal law that gives employees who lose their group health insurance coverage the right to continue their coverage for a limited time at their own expense is A. HIPAA, B. ERISA, C. COBRA, D. FMLA. Answer: C. COBRA. The Consolidated Omnibus Budget Reconciliation Act, or COBRA, is a landmark federal law that provides a temporary continuation of group health coverage that would otherwise be lost due to certain qualifying events like termination of employment or a reduction in hours. Eligible individuals can elect to continue their former employer's group plan for up to 18 months, or longer in some cases, by paying the full premium plus a small administrative fee. COBRA acts as a crucial bridge, allowing individuals and their families to maintain health coverage while they transition between jobs. Question 16. A life insurance policy that provides a pure death benefit with no cash value for a specific period of time is known as A. Whole life, B. Term life, C. Universal life, D. Endowment. Answer: B. Term life. Term life insurance is the simplest form of life insurance, designed to provide coverage for a specific term or period, such as 10, 20, or 30 years. It pays a death benefit to the beneficiary only if the insured dies during that term and does not accumulate any cash value, making it the most affordable type of life insurance. People often buy term insurance to cover temporary needs, like paying off a mortgage or providing for children until they are financially independent. The key takeaway is that term insurance is temporary protection with no savings component. Question 17. The primary purpose of the Medical Information Bureau, MIB, is to A. Set premium rates for member insurance companies. B. Provide medical care to uninsured individuals. C. Serve as a reliable source of medical information for underwriting purposes. D. Lobby for healthcare reform on behalf of insurers. Answer: C. Serve as a reliable source of medical information for underwriting purposes. The Medical Information Bureau, MIB, is a non-profit organization funded by member insurance companies to facilitate the confidential exchange of underwriting information. When an individual applies for life or health insurance, the insurer can check the MIB for coded information about past medical conditions or risky hobbies reported on previous applications. This helps underwriters detect misrepresentations and prevent fraud, ensuring that risks are assessed fairly. It's important to know the MIB doesn't contain detailed medical records but rather alerts underwriters to potential areas needing further investigation. Question 18. An annuity payout option that guarantees payments for the rest of the annuitant's life and for a specified number of years, even if the annuitant dies, is called A. Life only, B. Joint and survivor, C. Life with period certain, D. Cash refund. Answer: C. Life with period certain. The life with period certain option provides a lifetime income for the annuitant but also includes a guarantee that payments will continue for a minimum, certain period, such as 10 or 20 years. If the annuitant dies before this period ends, the remaining guaranteed payments are made to a named beneficiary. This option blends the security of lifetime income with a protective feature ensuring a minimum payout, making it a popular choice for retirees who want to provide for a spouse or other heir. Think of the certain period as a safety net for your beneficiary. Question 19. A health plan that allows its members to receive care from either in-network or out-of-network providers, but with a higher cost sharing for out-of-network services, is A. Health Maintenance Organization, HMO. B. Preferred Provider Organization, PPO. C. Point of service, POS, plan. D. Exclusive provider organization, EPO. Answer, B. Preferred provider organization, PPO. A preferred provider organization, PPO, offers members more flexibility and choice than an HMO. Members are encouraged to use a network of preferred doctors and hospitals, where they receive care with lower deductibles and copayments. However, the defining feature of a PPO is the freedom to seek care from out-of-network providers, though the member will have to pay a higher portion of the cost. A great way to remember the difference is that PPOs provide more provider choice at a potentially higher cost. Question 20. When must insurable interest exist for a life insurance policy to be valid? A. At the time of the insured's death. B. Throughout the entire duration of the policy. C. At the time of application. D. Only when the beneficiary is a family member. Answer, C. At the time of application. Insurable interest is the principle that the person purchasing a life insurance policy must have a legitimate financial interest in the continued life of the insured. This means the policy owner would suffer a financial or emotional loss if the insured were to die. For a life insurance policy, this interest is only required to exist at the time the policy is first issued, at the time of application. For example, a business partner has an insurable interest in another partner when they start a business, and even if they dissolve the partnership later, the policy remains valid. Question 21. What is the role of the Texas Commissioner of Insurance? A. To write and pass insurance laws for the state. B. To sell insurance policies directly to the public. C. To enforce the state's insurance laws and regulations. D. To represent insurance companies in legal disputes. Answer, C. To enforce the state's insurance laws and regulations. The Commissioner of Insurance is the Chief Executive and Administrative Officer of the Texas Department of Insurance, TDI, appointed to oversee and regulate the insurance industry within the state. The Commissioner's primary duty is to enforce all insurance laws, ensuring market stability and consumer protection. This includes licensing insurance companies and agents, examining the financial health of insurers, approving policy forms and rates, and investigating consumer complaints. Remember, the Commissioner doesn't create the laws, the legislature does, but is responsible for carrying them out. Question 22. In a disability income policy, the time between the onset of a disability and the point at which benefits begin to be paid is known as the A. Probationary period. B. Grace period. C. Benefit period. D. Elimination period. Answer, D. Elimination period. The elimination period, also called the waiting period, functions like a deductible in a disability income policy, but it's measured in time rather than dollars. It is the number of days the insured must be disabled before benefit payments will begin, with common periods being 30, 60, or 90 days. A longer elimination period results in a lower premium because it reduces the risk for the insurer of paying claims for short-term disabilities. Think of the elimination period as the time you must wait on your own before the insurance company's support kicks in. Question 23. An agent is helping a client purchase a new life insurance policy and has recommended that the client surrender an existing policy from another company to fund it. This action is known as A. Twisting. B. Churning. C. Replacement. D. Rebating. Answer, C. Replacement. Replacement occurs anytime a new life insurance policy is to be purchased and it is known, or should be known, that an existing policy will be lapsed, surrendered, or reduced in value to do so. While not illegal, replacement is highly regulated because it can sometimes be detrimental to the client. The agent has a special duty to provide the applicant with a notice regarding replacement, comparing the features of the old and new policies to ensure the change is suitable and in the client's best interest. It is a key compliance area focused on protecting consumers from losing valuable benefits in an old policy. Question 24. Medicare Part A primarily covers expenses for A. Prescription drugs. B. Physician services and outpatient care. C. Inpatient hospital care and skilled nursing facility care. D. Long-term custodial care in a nursing home. Answer: C. Inpatient hospital care and skilled nursing facility care. Medicare Part A is often called hospital insurance because its main function is to cover costs associated with inpatient care. This includes semi-private rooms, meals, and nursing services when a beneficiary is formally admitted to a hospital or a skilled nursing facility following a hospital stay. It also provides coverage for hospice and home health care under certain conditions. A simple way to remember is to associate Part A with admission to a hospital or facility. Question 25. What is the main purpose of a Medicare supplement, Medigap, policy? A. To provide coverage for long-term care. B. To replace Medicare with a private insurance plan. C. To pay for some or all of the cost-sharing expenses not covered by original Medicare. D. To offer prescription drug coverage as a standalone plan. Answer: C. To pay for some or all of the cost-sharing expenses not covered by original Medicare. Medigap policies are sold by private insurance companies to fill the gaps in original Medicare, Part A and Part B. These gaps include out-of-pocket costs such as deductibles, co-insurance, and co-payments that a beneficiary would otherwise have to pay themselves. A Medigap policy works alongside original Medicare to reduce a beneficiary's financial exposure when they receive healthcare services. The name itself is the best tip. Medigap policies are designed to fill the financial gaps in Medicare.